Barry, what's your best Apple story?
Oh, God. So I was a big Mac fan for a long time, and I got an early look at this newfangled iPod, not iPhone, iPod. And hey, this is the new Sony Walkman. At the time, I want to say Apple was $13, $15 with 13 in cash. So you were risking $2. My whole firm bought a ton of it. I held on to it and made fun of the guys who sold it when it was up $5. I sold it, it was a triple. And I'm like, look, I tripled my money. And then it just never looked back. And the lesson is, the trend is your friend. When something is working out, don't take the money off the table too soon.
Barry, in the CFA curricula of 3 exams, there's nothing on taste. There's nothing on aesthetic, which is what Steve Jobs led with. Describe how alone the Jobs' success is, or does taste and aesthetic matter in securities research?
So it does, but keep in mind, as much as everybody focuses on Steve Jobs, he's not the guy who wrote the software. He's not the guy who came up with a lot of the design like Johnny Ives did. He's not the guy who took care of all the logistics. That was some kid named Tim Cook. This was a massively successful company with rock stars everywhere you look. And the hyper focus on Steve Jobs, well, it was good and it was fun, but it really kind of hid the brilliance beneath the top. And I recall writing a column, I think it was like 03 or 04. Wall Street still doesn't understand Apple. And here it is, almost 20 years later, Wall Street still doesn't understand Apple. Think back 20 years ago when the Apple stores were introduced. That was the 20-year anniversary earlier this year. I love the articles that said, this is guaranteed to fail. It's the dumbest idea in business. The most successful retail outlet in the world are the Apple stores.
Well, and of course, Barry, Steve Jobs at the end of the day was a product guy, delivering on the tangible product. And Apple increasingly, yes, the iPhone is still its biggest driver, but it is also becoming a services company. And that is where a lot of the growth for the company is. Do you have to therefore think about it in a different way?
Yeah, so you have to think about them in terms of the entire ecosystem. So I'm talking to you on a Mac. I'm looking at my iMac. I have my iPhone. I'm not a big fan of the iBuds. They don't fit my ear well, but I do have their Beats wireless, which Apple also owns. But think about, the App Store. If that was a standalone company, it would be bigger than 80-something% of the S&P 500. It's giant. So they have music, they have television, they are end to end, and I just continue to be shocked. The biggest American publicly traded company still seems to be misunderstood by analysts. It's amazing.
Barry,
underestimated.
You've done this in your book and in your writings over the years. I've enjoyed 3, 4, 5 buys where I sold and should have held. What is the mental framework to not sell?
So when you're younger and a little broker, you start looking at trades that are working out. Hey, if I sell this here, I could buy a new car. And if this goes a little further, well, that's a down payment of a house. And that sort of mixing the real world to your investment portfolios, thinking about what it means in the real world, that's a problem that a lot of young investors run into. That's very different. I've told the story many times that mid to late 90s, I have vivid recollections of investors who had ridden through the 70s and enjoyed the 80s and 90s saying, I'm going to take a little bit off the table from my portfolio and I'm going to buy that vacation property. I'm going to do. That's very different when you're rotating from one asset to another than starting to think about your individual holdings. And P.S., the crypto bros love to do this with Lambos. Hey, 40,000 on Bitcoin, I'm getting a Lambo. Well, now it's 50,000. And the question becomes, is this a trading vehicle or is this something that you're using to change your lifestyle, to jump on that hedonic treadmill? Yeah. Not the best idea.
Barry, if you're looking to take risk off the table, what would be your reason for doing so? What is the biggest risk that you see?
Well, historically, investor behavior is always the biggest risk. Time and time again, that demonstrates itself. I've written starting in July, and I think the street has kind of moved in this direction, that the anti-vaxxers and having 30% of the American population who is eligible for a vaccine refusing to take one potentially puts us at risk for an echo of 2020, not a full lockdown, but an ongoing drag. I think the FDA approval yesterday might help that situation a little bit. And we've also seen corporate America's leadership step up. I'm not a big New York Post reader, but there's a very amusing story I tweeted out this morning about Wall Street mocking the anti-vaxxers, anti-logic, anti-rationality, anti-science members of their own. If you work on Wall Street and you're not vaccinated, expect to be humiliated and not be invited back to the office.